Good evening, ladies and gentlemen. Welcome to Reference Point. I'm your host, Dave Coker-Hook. And with me this evening is a returning guest, Narbek Karamian, who's the COO of Bena Group, who's been with us, 3 or 4 times over the last couple of years. Narbek, it's a pleasure to have you back. Thank you for coming back to Reference Point.
Thank you, Dave, for having me.
It's a pleasure. I'm glad you're here. I want to tell the folks what we're going to talk about tonight. In past shows, Narbek, whose profession has to do with the mortgage industry, has told us about some things ahead of time that came to pass. We talked before the subprime lending crisis hit and all these foreclosure things started to happen. He was on this show when we talked about that and projected that some of these things were going to occur. We talked about the impact of how things were going to occur with the commercial lending area that are hitting now. We were talking about that 6 or 8 months before those things occurred. Today we're going to talk about the Dodd-Frank bill, the bill from that Congress passed. I don't know exactly when it was. It was
actually in 2010, July 2010.
June and July of 2010, right. The bill that was passed to kind of reform the financial systems, to provide protection for the consumers, etc. And there are certain things about that bill that it directly impact lay people's ability to get a new home, or to refinance their mortgage, or to get out of the problems that they have in a debt type situation. Some of them are really positive. Some of them are things you got to watch out for. Some of them are not so good all the way around.
Right.
So we're going to talk about that this evening because, folks, I really want you to understand the impact of this and how it can help you if you pay attention to what's going on. So, Narbek.
Well, thank you,
Pleasure
Dave.
to have you here.
Thank you. It's good to be here. Obviously, I remember the last time we were here, we talked about the effect of the subprime crisis and it would have on the real estate industry, and we saw the impact it had. Everything tightened up, and we also mentioned that in a different show where regulations would tighten up and it would become a little bit more difficult, or so said, more difficult to obtain financing.
Right.
Right. So now 3 years later, we're actually talking about the actual implementation of this new law. It's considered one of the largest financial overhauls after the Great Depression back in the late 1920s and early 1930s.
And it's pretty huge. I mean, it encompasses a lot of areas. I was looking at a little briefing about it. It's a 16-page briefing of a 2,300 or 2,300 page bill, but it identifies it touches all kinds of areas.
Sure.
Renovations to the Federal Reserve, new federal organizations that are being put in place to monitor what's going on in the financial industries, and all kinds of things. And so this is going to be really interesting how it's implemented. But I really want us to talk a lot as we can about the mortgage reform.
Right. So ultimately, this law now, after it was passed, is touching on everything that went wrong back then. So this law is implementing all the precautionary steps the federal government has to take to avoid a similar crisis in the future. Okay?
Which is good.
So yeah, it consists of 16 sections, the Frank-Dodd bill, from which one of them attacks the mortgage industry, and this is section 14 if I'm not mistaken, and it really spells out as to how the mortgage industry is going to be regulated, while it was pretty much deregulated back then.
Sure.
Okay. Now it consists quite a lot of interesting things that it's covering, but ultimately all the things we mentioned back in your show previously, now it's becoming law that it's either becoming illegal or it's going to be tightly controlled. Okay. But this law, especially the one that pertains to the mortgage industry, touches on 3 major topics. One is consumer transparency, which was something that was not very very much available back then. Everything were the hidden costs, and we were talking about them.
Right.
So it's a consumer, transparent law. The other one is in this law it states that the consumers need to know exactly in detail as to how the loan originators, which used to be called loan officers back then, now the word across the industry is going to be loan originators, or MLOs, mortgage loan originators. How they can be compensated through a mortgage transaction. So, and one of the biggest things it touches upon is the consumer, or the loan, actually let's rephrase, I'll back up a little bit. The loan originator can only be compensated through one source.
Okay, I want to get into that in a minute, but you mentioned there were three things. So that you've identified two of them: the transparency, the thing, how compensation is affected, and what was the third thing?
Well, the second thing is the compensation by, and the other one is the mortgage originator shall receive compensation that varies based on the term of the loan. So any kind of loan compensation now can only be received based on the loan amount. It cannot be based on anything else. And I can give you an example so it might be a little bit more clear.
Yeah.
Is back in the days, there used to be multiple loan types. There were the negative amortization loans. There were these hybrid loans, which were a combination of 2-3 different kinds of loans. And the investors and the lenders had incentives for either the loan officers, the brokers, even the banks who were offering these loans. These incentives guided these industry specialists to provide certain types of loans.
So when you say incentives, you mean that there was some type of financial compensation to these various parties if they decided for this consumer here that they were going to put him into this loan. Is that what you're talking about?
That's correct. So if this loan, let's say if this was a loan, and hypothetically, let's use the negative amortization loan as an example. If this negative amortization loan had a prepayment penalty attached to it, there would be an additional incentive for the person who would sell this loan. Okay? So what was happening is not only was the consumer, let's use these as an example, it might be easier to. So not only, and we'll imagine this is the consumer, this is the loan officer back then, and this was the lender who was providing the loan on this home here.
Okay.
So not only was the person providing the loan being paid by the borrower or the consumer, but they were also collecting incentives from the lender by providing this particular type of loan. Okay. So the law now prohibits this from happening.
So I can see how it would have been very lucrative to be in this position.
Well, yes. It was, but unfortunately, due to the loose regulations back then, and also the deregulations, and also the fact that there were so many incentives being paid, the priorities as to how people were qualified for loans was wrong.
Right.
So now the law is correcting this issue. They're saying, okay, if a loan originator is doing a loan or is providing a loan, they can only get paid either by the borrower or by the lender.
Okay.
They cannot get paid through both parties. And this is part of that Transparency Act as to, everything needs to be disclosed.
Okay.
Now, back in the days, the incentives that were being paid to the loan officer were not disclosed. What was disclosed was what the borrower was paying for the loan.
When you say borrower was paying for the loan.
The consumer.
Right, but the consumer, what they were paying for the loan. What do you mean by that? Is that what we used to call points?
Yes.
Okay.
It had to do with points, or it also had to do, well, there are two ways that a loan originator can get paid. Either by taking a lower interest rate, for the consumer to take a lower interest rate and to pay for the loan costs.
Okay.
Or for the consumer to take a slightly higher interest rate and let the lender compensate the loan officer, where the consumer no longer has to pay for the compensation.
So let me see if I get that right. If I'm going to buy a home or I'm going to refinance, and I say I want a no points, no fees loan. So what you're saying is that they will present that to you on paper, but in actuality, the actual rate will be higher than it otherwise might have been if you were going to accept some of those fees.
Correct.
So that they still get their pound of flesh in the long run.
In other words, either way the consumer pays.
Either way the consumer pays, okay.
For the loan, whether they pay for it up front
or whether they pay it over 20 years.
Exactly, or they decide to take a slightly higher interest rate with a slightly higher monthly mortgage payment from which the loan originator is being compensated.
Which could actually end up ultimately costing them more money.
Well, the rule of thumb is if you're planning on keeping the mortgage for longer than 5 to 7 years, it may not be a bad idea to consider a consumer paid or to pay for the points and fees up front rather than through the higher interest rate.
Okay.
So that's the rule of thumb. But ultimately, nowadays, this is no longer the case. Okay. So there cannot be any hidden incentives for the loan originators, and also the consumer has to decide upfront whether they would prefer to pay for the costs of the loan through, out of their pockets, or whether they would like the lender to pay them. And all of this has to be disclosed in the good faith estimates that have come.
So if the consumer makes that determination up front and changes his or her mind, what happens?
Well, once you go into a contract as to, you want to get a loan and you go to Wells Fargo, Bank of America, or even a broker, the first thing that you're going to see nowadays is they're going to ask you, would you like to pay for the loan costs, or would you like the lender to cover your costs? This was not a question that was asked before.
Okay.
Okay, so that's because nowadays there's truly two different programs out there. While back in the days before this April 1st implementation of the law, though it has been delayed, though it's been appealed and it's been delayed, so we're waiting for the final ruling on April the 6th. But before that, there was one rate sheet and consumers could decide whether they wanted to pay for it out of their pocket or not. But now there are two separate rate sheets. One is for the consumer paid and one is for the lender paid. So the consumer has to determine that in advance because of all the disclosures, as we talked about the transparency info, all of these things have to be disclosed.
Does this make it easier or more complicated for someone who's looking to get a mortgage?
Well, since there's a lot of protection going on, the consumer protection, it's called the Consumer Protection Act. So there's a lot of protection parameters involved. So ultimately it's protecting the consumer.
Right.
But yet there are a lot of disclosures now taking place. So it's imperative for the consumer to understand the documents that are being provided to them.
Okay, so it sounds like what's happening, if I'm interpreting what you said, Narvik, to mean that the consumer is now being presented with information and variables that they were not presented with previously. So now their need for education on what this process is all about is a little more significant. It's higher than it was before because now they have to make decisions. And if you're not clear on what those impact of those decisions are, you may not make the most optimum decision.
And one of the important recommendations I would make is by law, and we covered this back in the day, this law hasn't changed. Once you're involved in a contract to obtain financing, as the loan application is taken from the consumer, the loan provider, whether the broker, the loan officer, or the bank, has 3 business days to provide a good faith estimate. Okay. It's imperative now to question the good faith estimate.
To question it.
Right.
And
I actually had a good faith estimate I brought as an example.
Question it, what do you mean by question it?
Understand it very thoroughly because, let's take a look at it a little bit. So here's a copy of the new good faith estimates. This was passed actually in December of 2009.
Okay.
So now this is what's being used, and it's 180 degrees different than what it used to look like back then. It was a one-page sheet. Now
it's got 4 pages.
Yeah, 4 or 5 pages. So it has about 4 or 5 pages to it. So it's broken down much more in detail, and the most important part that I would recommend that we need to focus on is, actually this is the interpretation. On page 2 and page 1. So the page 1 of the good faith estimate has boxes A, B, and A plus B. Okay. So in our industry, these boxes actually are known as box A and box B. So the consumer can easily, ask their loan officer or their loan originator, what is box A? And they have to explain it to them because here, as you can see these numbers, they're broken down on page 2. Okay. But so ultimately, box A and B is the number that the consumer has to pay to obtain this loan. Okay,
this is the bottom line.
This is an example.
In this example, these two boxes A and B represent certain fee structures of some type.
Correct.
That the net addition of it is this is what the loan's going to actually cost the guy over and above.
Right.
If he's borrowing $400,000, then the amount that he's going to end up paying over and above the $400,000 is.
That's correct. Now, box A consists of anything that pertains to the loan, loan costs.
The loan costs.
Loan origination, all of loan origination and underwriting, anything that's connected to the loan.
So the things that the the bank or whoever is providing the loan have to have costs for?
Correct.
So
It's
that
like
things-
underwriting fees. The bank
Underwriting
has
fees?
to charge
Okay.
to underwrite the file. It's the fees they pay the broker or the loan officer at the bank level
And
to obtain the loan.
The what do you call it? The appraisal fees and things like that.
No, that falls into this category.
Okay, but
now,
that's an
box B
yeah.
is all the miscellaneous costs.
Okay.
Okay. Now, the breakdown of box B is on page 2. That's totaled down here. So I've highlighted this. So box B, the total of box B on page 2 needs to match box B on the first page.
Right.
Okay. So there's a breakdown here that needs to be questioned.
So these are all the miscellaneous costs associated, like for example, what I just mentioned,
Correct.
the appraisals or any other
Exactly.
thing that may be an expense point that the bank is going to have, or whoever is providing the funds is going to
Correct.
have.
And this can be,
And the consumer ends up paying for it. They always did pay for that, right?
Right. It's just the way it's interpreted or it's shown nowadays or disclosed is slightly different than it used to be.
So are people likely to look at this and say, gee, I bought a home 10 years ago and I didn't have any of these fees? And
It's
think
possible.
that that's the case?
Yeah, it's possible because there are separate line items for each category nowadays.
And before they were just sort of like
They were there, but it wasn't imperative for you to include them. It was because even back then, there could not have been more than a $300 discrepancy between the initial good faith estimate and the actual good faith estimate, but it wasn't really followed correctly. Now, the other question that I get asked quite a lot is on the loan origination side. Back in the days when we talked about, again, we're going to use these as an example, if the consumer wanted to obtain a loan, and they would say, you know what, I don't want to pay for any of the loan costs. I want a no-point loan. So what would end up happening was the consumer would take a slightly higher interest rate, and the lender would compensate the loan originator for their work, right? So the consumer would not be involved in any kind of compensation paid. This was not disclosed back then. But now this also has to be disclosed. Even though the consumer is not paying for it, it still has to be disclosed because of the transparency.
So anytime there's some sort of financial compensation, wherever it comes from, the borrower needs to be informed?
Correct. And this,
okay, so what impact does this have on the industry?
Well, first of all, before we get there, let's talk about the impact it has on the good faith estimate. Because now, if we look at box 1, which was the loan origination, it shows that the consumer has to pay $4,000 and some dollars in this example, from which $3,000 of it is coming from a different source. It's a credit back to the consumer.
Okay.
So in reality, the bottom line number is $930 in this case, whatever, and this can be an underwriting fee. But so the way they're showing this now is if hypothetically the loan originator is making $3,000 or $4,000 from the loan, they have to take this $3,000, give it to the consumer, and then the consumer ends up paying them back the $3,000 that the loan officer or the loan originator gave back. So they've made it a little bit more complicated here because of the transparencies involved and the disclosure. So the lender can no longer pay the loan officer through their direct compensation. This compensation has to be disclosed in the good faith estimate as a credit to the consumer.
A credit to the consumer because the consumer is going to pay it back.
And then the consumer ends up paying the loan.
And that's if the consumer says that they in fact want to pay.
Do not want to pay for the
cost.
If
they do not want
the lender to pay because that's a negative number.
Oh, so if they don't want to pay for the costs,
it still has to be disclosed.
It has to be disclosed, but on paper at least, the bank says that they're providing the consumer with X number of dollars, and the consumer then is going to, now does an actual transaction take place, or is it all on paper?
It's on paper.
It's on paper.
It's like a debit credit, but it has to be disclosed.
All right, all right. So it's not that onerous then.
So the questions I get asked a lot is, how come my closing costs are so much? Because the credit is also showing as part of the the cost. The charge is also showing as a cost, but then it's being reversed through a credit to the consumer.
Okay, so let's get back to this thing. What impact does this have on the industry?
Well, a couple of things. You know, I took a couple of notes as to what we're going to see. Okay, so a couple of things. One good thing about this new law is consumers are going to see only one line item for loan or mortgage costs.
That's a good thing.
That's a good thing. So there can no longer be a breakdown of underwriting fee, processing fee. There were so many minor, fees here and there. It all has to be consolidated into box A.
Okay.
Okay. And that's why it's important for the consumer to ask the breakdown.
Oh, so
because there is no breakdown here. It's just consolidated into loan charges.
okay.
Okay. And this number has to match to what the consumer and the loan originator initially spoke about.
Okay.
Okay. So that's one thing. Now, the consumers will now only pay, either they can decide whether they want to pay the loan originator directly, or they want to let the loan originator be compensated through the lender. Back in the days, the loan originator could collect half of its charges from the consumer and half of it from the lender, allowing the consumer to take a interest rate between these two. Right? So if let's use an example, if this rate was, if the consumer decided to pay for the loan, the interest rate would be 4.875, while taking a lender compensation, which the lender would pay, it would be, let's say, 5.25.
Okay, so they were able to play the system a little bit to get that down and pay partial, etc.
Right.
But they can't do that.
They can't do that.
So how does that impact the industry?
So there's not going to be a fractional increase in interest rates as to what the consumer can choose. Because they could possibly take a 5% interest rate and pay partially out of their pocket and allow the lender to pay that.
Do that.
They can't do that anymore. Okay. So it has to be strictly either from the consumer or from the lender. There is no in between. So in a nutshell, the law states that the loan originator can only be compensated by one party.
So what does that do to the industry, the loan origination industry, the mortgage brokers, loan officers from the banks and stuff like that? There's just like a gazillion of these people running around. At least there used to be.
Well, yes, there used to be.
There used to be. What impact does the law have on the industry?
First of all, it's streamlining everything and it's uniforming everything, as I said, because the law indicates that the loan originators can only be compensated based upon the loan amount.
Okay.
No other means of compensation.
Only based on the loan amount. Okay.
So their compensation can only be connected to the loan amount.
Okay.
They can't say, okay, well, now I'm doing, even though it doesn't exist anymore, but now that I want to do a negative amortization loan, I can be compensated more this way. Those things are, so hypothetically, even if the negative amortization loans were to come back in the future, it would eliminate any kind of incentive. Exactly, additional compensation. So that's one thing that it's going to set forth in the industry right now as far as uniformity. The other thing is it's going to be a lot more transparent, as I said. So that's one of the. I've taken a couple of notes here. So, but one important thing that again is important is for the consumer to decide whether now they want to pay for the loan or they would like the lender to pay for the loan. This
one
is
of the
big
things
issue.
I'm kind of pushing on here. I have some friends who have been who are in your industry that have gotten out of that industry now because they're concerned that their ability to make the kind of income that they have made in the past is negatively impacted by this process. Is that accurate?
Well, what happened to the mortgage industry was it used to be a very healthy industry. And then during the early 2000 to the mid 2000, it really went out of control.
Sure.
So the income that certain, obviously, brokers or loan originators were making really went beyond the curve of the normal income that there should have been. It's now come down to where it should be.
Okay.
Okay. So what happened was when the sources of income imploded, there were more people coming into the industry. Okay. So I believe at one point in time, I read that there were about 380,000 loan originators or loan officers back then in the nationwide.
Wow.
We're down to 170, 180,000 now.
Okay.
Okay, so there's been a lot of regulations now, besides this, brokers and loan officers had to take federal examinations under the federal laws to abide by them. So there's been, this industry has really gone through a lot of reform.
We have less than 5 minutes left in the show, Narvik. So what I'd like to sort of summarize here. It sounds to me like in general, or for the most part, let me put it that way, that the sections of the law that pertain to mortgage activity have been structured to provide the consumer with a better, safer environment. So in essence, this is actually a good thing. For the most part, this is actually a good thing.
Correct.
What's the downside? Is there a downside? Is there something that the consumer needs to be cognizant of and should be thinking about, other than what we've already discussed here of making sure that they understand where these numbers come from?
Right.
Is there anything that they should know because of these changes, so they don't step on and hurt themselves?
Well, one thing I would definitely encourage consumers to do, as I said, because the sources, this particular section we're covering right now is strictly, speaking about the compensation factor. Okay? So it's important to know what the compensation is, because there's so many numbers disclosed in the good faith estimates that if these numbers are not understood easily, they may end up paying a lot more for a loan than they should have.
Okay.
Okay, and that's one critical thing, because there's the compensation is coming back to the borrower as a credit, and then it's being charged back.
So it's a question of making sure you understand what this information really means. Is there any reason? I had heard something, I don't know if this is true or not, because everybody, when you don't understand something, you create conclusions that are not based on fact. But I had heard it said by someone, I don't even remember where I heard this, that they thought that these changes actually had the potential of driving interest rates up. Is that logical?
It's a possibility. There are a lot of rumors floating out there. It's very new, and there are a lot of things that need to be fine-tuned here. But there's a possibility, because the government is holding banks, brokers, lenders accountable. There's a possibility that they might raise interest. As I said, these are all rumors. They might raise the interest rate slightly to create a safety buffer for themselves.
Okay, which is a little bit of a different structure that doesn't kind of cause it to sort of go out of control. So we're getting down to the end here of our time. I think what I'm getting from this discussion is that the impact of the Frank-Dodd bill as it pertains to the mortgage situation for people is dominantly positive. The key for the consumer is going to be to make sure you understand the impact of these transparency changes that have been made and the compensation information that's been presented.
Correct.
Because if you don't, you could end up in a less than favorable situation.
Correct.
Is that pretty much it?
That's correct. And I also encourage people to know their loan officer very well. As I said, this is a little bit more complicated than it used to be. So it's imperative for them to know the loan officer or the loan originator they're working with, and to be aware that they have enough knowledge to be able to explain this to them properly. Okay,
got it. So, ladies and gentlemen, I want to suggest to you that if you have any questions about this topic, to send us a query. info@referencepointtv.com is the email address for Reference Point. We'll get that information off to Narbek as you have any questions. And just understand how this can help you, or if you don't pay attention to it, how it might be a little negative thing for you. Well, that's pretty much it today, Narbek. I really appreciate you coming back and being a guest on Reference Point again. And ladies and gentlemen, we'll see you next time.